Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that, if we zoom in onto the daily chart, is currently a line of resistance that goes back to these two big highs here. So market being at resistance after almost a 20% move higher from that June low. A lot of people right now are calling for a bear market rally. Now, as we're going to quickly discuss in this video, we've seen a very, very powerful move here, right? A very, very strong move with lots of momentum, a significant change in character relative to anything that we've seen that looks a lot like previous very significant bottoms, right? That's something we're going to discuss in this video, but you do have an incredible amount of things to be concerned about. A lot of people are talking about a bear market rally here. And so that's what we're going to discuss in this video. We're going to discuss some of the concerns that are out there, perhaps giving the flip side of the coin to the S&P 500 right now. I feel like that is important considering we've seen an 18% move higher in the market and we are at resistance. Despite lots and lots of promising signs here, it's important to stay level-headed. You can see here on the MACD, we have a bullish crossover that looks incredibly powerful here, at least for now, right? We have a lot of momentum behind this move, similar to some of the previous moves we've seen off significant bottoms in the market that led to big bull runs in the months that followed. But from a pure technical standpoint, we are below the zero line here on the MACD on this weekly chart. And so if you start to see the momentum fade in the next few weeks, next couple of months, and the market not keeping up with that bullish momentum, could that start to look more like what happened here in 2015, where you had this bullish crossover and then the market returned back to retest the low? Or even in 2008, where you had a very similar powerful bullish crossover right here that was then faded as the MACD failed to return back above the zero line during that bear market rally. But keep in mind that this took months to happen. So staying open-minded, watching the behavior of the market every week is very important, and always reevaluating the thesis should be our primary objective. So in this video, I want to discuss, first of all, the yield curve inversion. This is something that a lot of people have been asking me about, and so I think this is a very relevant point to include in this video. It's the 10-2-year yield curve that has gone into negative territory, meaning that the 2-year is now at a higher rate than the 10-year yield. Now, a quick explanation to that, there's two ways to interpret this. First of all, shorter term rates are a lot more associated with monetary policy. So what the Federal Reserve is doing, and basically what the market, the bond market, expects the Federal Reserve is going to do in the near term. Whereas the 10-year yield takes a lot more into account the growth aspects of the economy. And so when you have the yield curve inverted, it's telling you that the bond market expects that the Fed is going to over-tighten. They're going to tighten too much relative to the growth. And so this is why yield curve inversions are a great predictor of recessions, because when monetary policy from the Federal Reserve hiking rates, when that gets too tight, when that gets overdone and growth is already slowing, that's when you have recession risks increase. And that usually occurs when the yield curve is inverted, which is definitely the case now. So this is the bond market telling us that the Fed is tightening here into a slowdown, and pretty aggressively so. Now, on the flip side, if we take a look at the 10-3-month yield curve, it's not yet inverted. So we are at that awkward moment in the cycle where we do have some parts of the yield curve that have inverted, but not all of them. And just in case you were wondering, before 2008, before the 2008 financial crisis, or even before the 2000 to 2003 recession and bear market, you did have the 10-year minus 3-month yield curve go inverted, right, in both cases, and before COVID as well, right? So that's not the case now. Now, another interpretation of the yield curve is that this represents the banking system's business model for loaning out money. Domestic and commercial banks usually loan money from the central bank, so from the Federal Reserve. They loan money from the Federal Reserve at a short-term interest rate. So that money goes from the central bank to the domestic bank, and then the domestic bank loans that money out to individuals and corporations on a longer term yield, so the 10-year yield. And so the vast majority of the time, the 2-year yield is lower than the 10-year yield, meaning that this business model is profitable. Banks can actually make money loaning money from the central bank at a short-term rate and then loaning it out at a higher, longer-term rate. This is how credit can grow, right? When domestic banks lend to corporations and to individuals. But what happens when the yield curve is inverted? Well, you have the 2-year that is at a higher rate than the 10-year, right? So that means that it is no longer profitable for banks to take short-term loans and give out longer-term ones. And so that upwards growth in credit turns into a deleverage of credit. And you can see this is something that we've gotten data on just this month here on the net percentage of domestic banks that are tightening standards for commercial and industrial loans to large and middle market firms, right? So this is how many banks are tightening their standards. And you can see Q3 here, Q3 2022 is the first quarter where we've seen banks tighten their standards since COVID. Now, before that, it was 2007, and before that, it was 2000. Right, both of them triggering major recessions, and before that it was 1990, also triggering a recession. So this is very much a leading indicator of recessions. And perhaps I can show you that and prove that point to you by showing you what that graph looks like when you put it on top of the unemployment rate, the US unemployment rate. So let's add that chart here of the net percentage of domestic banks tightening. And you can see right here, as tightening standards were elevated here, it led unemployment higher. As tightening standards increased here, despite a very low unemployment rate, it eventually led to a rising unemployment rate. Again here in 2007, increased tightening standards during a period where unemployment is low eventually led to a deep economic contraction and a rising unemployment rate. Now, of course, COVID was very strange, so we'll leave it out. It's definitely an exception in terms of the dynamics that occurred during COVID, both in terms of how the unemployment rate started to rise, why the tightening standards increased, and then why they came back down because of unprecedented monetary policy and fiscal policy interventions. So it's definitely an exception. But here, we're seeing the same phenomenon where we're seeing tightening standards increase despite a low unemployment rate. And theoretically, you should expect that this is pointing towards an economic contraction with a rising unemployment rate. So all of this and the yield curve inversion mentioned at the beginning of the video is indicating, at least in our opinion, that we are coming towards the end of an economic cycle. This is not the beginning of an economic cycle, it's the end. You're seeing a yield curve inversion, tightening of standards, and all of that is happening while the unemployment rate is low and stocks are generally pretty high. So if you want to make today's macro environment look scary, you can absolutely do that. You can absolutely get freaked out around everything that's going on from a macro standpoint. In fact, that entire background of information can sound incredibly scary when you take a look at today's price action. And I'm filming this pre-market, so who knows where the market will be by the time I post this video. But we are deep in the red, the biggest red days since June of 2022. And it does look like we had the overbought RSI reading work like a charm, right? You had this overbought RSI reading at resistance, testing the 200-day moving average. Very similar overbought RSI reading right here in November. And you've had several overbought RSI readings that led to short-term periods of consolidation. It's generally a bad place to enter the market when the RSI is overbought, right? A very poor place to enter the market. This was a chart that was highlighted in last week's S&P 500 update, where we did highlight that overbought RSI reading here as the market was really going on a parabolic run. We highlighted previous RSI readings that led to short-term periods of consolidation, right? It's not rocket science. You don't have to be a genius to figure this out. You just have to be objective, look at an overbought RSI reading as the market is testing resistance. This is another chart from that article here with that downtrend line resistance, 200-day moving average right here in red, overbought MACD, overbought RSI. It didn't guarantee a pullback was coming, but it did significantly increase the odds. And we highlighted a few important support levels to watch out for that would be typical retracements of that move. So what we're seeing right now is none other than a typical retracement. We're only coming to the first support level that we highlighted in that article. You could see the market move all the way down to our third support level at 3,900 points and still very much remain in a bullish formation with a higher low forming. So we will be watching these levels and the price action along the way very carefully and continuing to post these updates every week to see if the market is actually showing signs of putting in a local bottom before resuming higher, or if we're seeing pretty worrying signs along the way down that should make us reconsider our optimism on the stock market. So why have we talked about the 5,200 point target here that we have on the S&P 500? We even talked about 5,300 points at one point. Well, firstly, we're coming out of a moment. We're coming out of a correction where you've seen a historical amount of pessimism. Look at this. This is the AAII Bulls survey with a 50-day moving average on that survey that shows you we're really at historical lows. And I'll quickly run you through each example here. Look at every time you have a low, what happens to the stock market? It creates a run. Every time a low creates a run, a low creates a run. This even happened in 1998, right? A low in sentiment created the final run to the top. Then again, a low in 2003 created the bull run between 2003 to 2007. Then the low in 2008 created this bull run. So the market likes to rally significantly after sentiment has seen an extreme reading. On top of this, we're seeing the 100-week moving average being reclaimed, which has historically coincided with the resumption of the secular bull run. Every time it's been reclaimed, you see a big rise in the stock market, right? So that's a relevant point. Even though it's purely technical, it is relevant from a market psychology standpoint that this bull market moving average holds. It lets investors that were concerned about the market come back in as they see that safety net of the 100-week moving average under them, and that lets momentum pick back up again. That wasn't the same behavior that we saw in 2008 where the 100-week moving average was rejected, at least not for now, right? We could still move back under here and that would be bad news. But for now, it looks pretty constructive. We've also seen some key breadth indicators trigger positive signals, right? This is the percentage of stocks on the S&P 500 that are above their 150-day moving average. This is an indicator we've been watching for quite some time. It moved from very low to around 59% in a very rapid, swift move. And you can see those moments are highlighted right here with a vertical line on the chart below. We had a signal in 2020, in 2019, in 2012, in 2009, right? All corresponding to the beginning of major resumption of bull runs. All of that with inflation that is showing lots of signs of coming back down, right? You can see here, this is a chart that I've shown many times on this channel. Inflation peaks. I'm going to put a vertical line every time inflation peaks, but you can see major market bottoms coincide with inflation peaks when inflation is trending above 5%, right? These are all the times inflation trends above 5%. You can see even 1990 here, that was the inflation peak coinciding with the bottom of the recession in 1990 here. And we have good reason to believe that we've seen the inflation peak. And in fact, the market bottom and the swift recovery off that low has coincided perfectly with that inflation peak. So as you continue to see inflation cool down, that would give an excuse to investors to continue bidding the market higher. So it does seem that this is really the window of opportunity for the market to move higher and to get very optimistic. But we are very much aware that there is a roof over our heads, This is the end of the economic cycle where contractions in company earnings are more likely, rising unemployment, and some type of a black swan event like a financial crisis, whether that's in the US or even if that stems from outside of the United States, somewhere like China that's having big troubles with their housing market right now, that could lead to a significant decline and an underperformance in economic activity and underperformance in S&P 500 stocks that would lead the market lower. So this is how we're thinking about the market right now, putting everything on the table. And I think that's something that we're going to do more and more as we continue to see the market climb. Because now off the low, we've seen almost a 20% move in the market. That's almost halfway to the 5,200 point target that we have. Now, if you want to keep up to date on that, want to know our specific reasoning and our opinion every step of the way, you want to stay updated on our convictions and how we're currently looking at the macro situation, the indicators that we're currently looking at to see if the market strength is losing momentum and whether fundamentals are starting to really deteriorate and for there to be a significant reason for the bull run to end, make sure to click on the link down below and check out our website at gameoftrades.net. Every week we post updates on where we think the market is, both from a technical, intermarket sentiment standpoint and also from a fundamental research standpoint. What does the macro environment look like, as well as all the other opportunities that we're currently looking at on our trading watch list, whether that's long or short, how we're currently hedging ourselves for the environment that's to come. For example, treasury bonds that we've written about, and we're frequently updating our members on using TLT as a hedge against a financial downturn. So all of that is updated through the articles and through the trading watch list, through the articles that we have, through entry setups, personal targets that we have, and through our trading watch list. We also summarize the articles through a summary and a conclusion if you don't have the time to go through the entire thing. So if you are interested in that type of service, test out our free trial. We do have a 7-day free trial where you can test out the service, check the ins and outs of our articles, see if that's something you'd find useful, and that is completely for free. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.